In July 2012, the European Central Bank's then President Mario Draghi gave a speech that is now credited with saving the euro.
The ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
Greece was in the middle of a debt crisis, and economic instability was spreading to other parts of the Eurozone. The ECB, the central bank for the countries that have adopted the euro, had to act. 10 years later, the euro and the Eurozone are still intact, but one core issue at the heart of the crisis still remains. In fact, it rears its head every time the region comes under economic pressure. In 1999, 11 countries came together to use one single currency, the euro. As of 2022, the euro area boasts 19 members. And while all the countries in the Eurozone have one currency and one central bank setting interest rates, it's up to their national governments to set their fiscal agendas for the year. This means making big decisions around taxation and spending. Unsurprisingly, 19 diverse nations are not going to be in total lockstep on those decisions. Take a look at their debt levels, for example. A country's debt to GDP ratio is a metric that compares a country's public debt to its total output, or gross domestic product. And the range across the euro area is huge. Estonia, for example, has a debt to GDP ratio of about 17%. Germany's is at 67%. Italy's is at more than 150%. And Greece, even to this day, has a debt to GDP ratio of almost 190%. When countries want to raise money from international investors, they issue bonds. This is kind of like a country handing out IOUs, which pay interest, in exchange for investment that they can then use to fund government projects, for example. Bonds are a well-established part of the financial market. So why should we care if one country has more debt than another? Well, if a country is sitting on a lot of debt, this means every year a big chunk of its financial commitments will go towards servicing that debt or paying interest to whoever owns it. The higher the debt load, the more investors worry every time yields go up. Bond yield is how much an investor earns from holding bonds. While bonds all have a set coupon rate, the term for a bond's fixed interest payments, a bond can be bought for more or less than its face value. This will affect the total yield of the bond. For example, a bond bought at a lower price will have a higher yield than a bond with the same coupon bought at a higher price. Bond prices often fluctuate based on credit ratings. If a bond is seen as investment grade, you pay more. If it's seen as junk, you pay less. So as the price of a bond goes up, its yield goes down, and vice versa. Angel Obide is an expert on finance and European affairs. He explained what this means for the Eurozone.
Two identical firms or households have different financial conditions or funding conditions, just as a result of the country they are located in. So in some sense, as if your passport becomes the major determinant of your funding conditions. Of course, there should be differences. But when the differences are very big, then we can say that monetary policy has been fragmented.
Vitor Constancio was vice president of the ECB in 2012 during the European debt crisis.
With a monetary union like the one we have, the national debt markets are sort of demoted to regional markets, and then the countries themselves cannot issue their own currency. So that's a structural reason that makes national debt more bound to become vulnerable and under pressure of markets.
Basically, what you're saying is the reason fragmentation exists is because the Eurozone, by design, is a monetary union. It is not a fiscal union.
Yes, basically it's that.
Let's return to the Greece crisis to understand how this can turn into a problem. After it emerged that Greece's reported budget deficit had been grossly underrepresented, there was concern that its government would stop making repayments on its debt. This scared investors. So they started placing a higher premium on owning bonds issued by the country, and Greek bond yields shot up, at one point touching 30%. This effectively locked the country out of the borrowing market. No investors wanted to touch the bonds out of fear that they wouldn't get all their money back. A restructuring of Greek sovereign debt took place in 2012, which saw private investors take a 50% haircut on the value of the bonds that they owned. It also saw the country enter into a very strict austerity program under the supervision of the EU, IMF, and the ECB to get its public finances in order.
The Greek crisis was very important, not just because obviously the tremendous economic damage to Greece, but also because it created this sort of feeling in the Eurozone that all the crises were fiscal and everything had to be solved from the fiscal standpoint. But there was also another issue, that is that famous walk between Sarkozy and Angela Merkel, that every resolution would require a bail-in. It would require that private investors participated in the resolution. And so that created this environment into which every deterioration of the fiscal outlook made investors believe that there was going to be a restructuring that was forced by the rescue or by the support.
Which is why this crisis didn't end with Greece. Investors were quick to price contagion to other countries like Italy and Spain, where the fundamentals had not changed significantly. And Europe's bond yields, which had been similar since the euro was introduced, began to diverge. Investors had stopped seeing the Eurozone as one cohesive bloc, but instead a group of disparate countries with very different financials. In short, the Eurozone started to look fragmented. This is when Draghi's Whatever It Takes speech came in. After the speech, the ECB introduced a new tool called Outright Monetary Transactions, or OMT. It would allow the central bank to purchase an unlimited amount of government bonds of indebted nations, subject to stringent conditions. The OMT tool itself has never been used, but the existence of it was enough to bring spreads down because investors felt comforted that central bank support would arrive. For many, this was a turning point.
What do you think the consequences would have been if the ECB had not acted in such a way then?
Well, I don't want to speculate about that too much, but of course the pressure would continue. Yields of Spain and Italy were very high, 7-8%, no justification really. And so this fragmentation would perhaps continue. And markets thought apparently that they could force a restructuring also of the Italian and Spanish debt and Portuguese debt and all of that. Well, it didn't happen because we intervened. At that stage, we understood that this was a sort of domino, because then after Italy and Spain, it could go to France and so on.
10 years on, in 2022, fragmentation risks in the Eurozone started rising again. This time, the ECB introduced another tool called the Transmission Protection Instrument, or TPI, which could also be used to help stabilize bond markets if needed. One other difference this time around is EU nations have moved a little closer towards joint bond issuance. That takes the pressure off individual countries in times of need because it doesn't add to their national debt pile. The COVID-19 pandemic brought about the introduction of a new, large common instrument with the launch of the Next Generation EU funds, a €750 billion package financed and distributed at the EU level, not the national level.
Some embryonary elements of the fiscal union are now being born.
Obviously, there's some macroeconomic pressures at play right now, but in terms of the bloc itself, how resilient is it compared to previous episodes in history?
Well, there is really no comparison. The situation is much stronger now, starting, of course, with the banking sector, which is quite well capitalized and robust and went through the COVID crisis, showing that it did kept its robustness. We had to prove that Europe creates the necessary backstops when the situation becomes too acute or dangerous. And I am sure that markets will not attempt to bet against the euro area the way they did before, because it has been shown that the euro area reacts, and when the situation becomes acute, provides the backstop.